Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello students, this is the review of CA Final AFM MTPs that were released in September and October. Two series of MTPs were released, and one of the students reached out to me saying that, sir, are there any important questions from these MTPs? Is there anything new that is there? The student obviously has not solved, and he reached out very close to me, close to the exam, just a week before the exam, and he said, sir, is there anything important? So one of the reasons why I did not do a live session on MTPs was everything is very simple. There were one or two small questions which are not from P600 plus. Otherwise, everything is from P600 plus. Okay, one or two questions on practical stuff which are not from P600 plus. So that I will solve, but everything else is from P600 plus. In fact, the case studies are also directly taken from past questions. Okay, so first let us look at this thing. I am not going to solve the questions. I am just going to give you references in P600 plus. You can go and search for it. But there are some questions, specifically MCQs, that I will solve. So basically I will solve MCQs. I will not solve all non-MCQs descriptive questions. One or two descriptive questions which are very important, I will solve. Okay, fair enough. So let us see. First I look at series 1, that is September MTP. In that, let us go and look at the first MCQ. Bank A is in need of fund a period of 14 days. To meet its financial need on 20th September, it enters into agreement with Bank B, which would sell 10% government bonds issued on 1st Jan at 5.65% for 8 crores. Face value is 10,000 per bond. Clean price is 9942. Initial margin is 2%. Maturity date is 31st December 2028. Consider 360 days in a year. Interest is payable annually. Based on the above, answer the following. So, what is the first thing I told you? Don't read the case, directly come to the question. What did I do? I read the case because it is a 5-line, 6-line case. Otherwise, don't read the case, come to the questions. Now, first, based on the above, what is the arrangement between Bank A and Bank B? Bank A and Bank B are borrowing. For that, they are giving a bond. Okay. They will sell a bond and buy back. What is it called? It is called a repurchase obligation. It can be done between banks. It can be done with RBI also. So, answer is, it is not call money, commercial bill, commercial paper. It is a repurchase option. Okay. So, what is dirty price? Dirty price is equal to clean price plus accrued interest. What is clean price? Clean price is 9942. What is accrued interest? Accrued interest is your face value into coupon percentage into days by 360. What is the days here? Till 20th of September. Okay, so if it is 20th of September, how many days are there? Till 20th of September, how many days are there? In the issue date is 1st Jan. So 31 plus 28 plus 31 March plus April 30 plus May 31 plus June 30 plus July 31 plus August 31 is 243 plus how many days? Plus 19 days of September makes it 262. So you have 260 days. So into 262 divided by 360. This instead of days, it is 262. So how much does it work out to? 10,000 into 10% into 262 divided by 360. That makes it 728. 727.77. 728 plus 9942. That you get 10669, which is 10670. Answer is B. Then the start proceeds. What are start proceeds? See, they have said there is a margin of 2%. Then they have said face value is 8 crores. Okay, for 8 crores. Face value is 10,000 per bond, 8 crores worth of bonds. So, when you do this kind of bonds transaction, right, what is the formula? Notional value into dirty price by 100 into 100 minus initial margin by 100. What is notional value? They said notional value is 8 crores, 8 CR into dirty price. What is dirty price? We found out 10760, 10670 by 100. Okay, should be 100 or should be 10,000? See, when the face value is 100, then this is 100. So here it should be 10,000. Okay, into 100 minus initial margin. It can be 100 here. Yes, it can be 100 because here we are doing from a percentage basis. What is initial margin? 2%. Okay, initial margin is 2. Okay, you can take it as 2 by 100. Okay, so 8 CR into 106.7 into 0.98. That will be, let's work out to 836,528,00. Okay, do we have any answer close to that? Yes, we have 836,530,00. So answer is this. Then Second leg of the transaction. What is second leg? That is return. How much will you return? So obviously you will not be returning this. Okay, you will return it along with interest. What is the interest? Interest is accrue 14 days. 8365300 into 14 by 360 into 5.65%. So the interest will be 183804.2 plus this is the interest. Return is equal to this is A, this is B, A plus B, that is equal to plus 8365300. You get 83836,804. 83836,804. See, this is the answer. These two look very, very close. Okay, but the correct answer is A. Okay, so what is the amount of accrued interest? Array, we just now computed, no? 728. So it is a simple answer, 728. Okay, now let us move to case scenario 2. Case scenario 2, this actually is illustration 6 in mutual fund chapter. Okay, but I still want to do it because case studies, a lot of you are getting tense. Okay, that is what is the feeling that I get. So let me do this for you. An asset management company of mutual fund is, no, first not the case questions. Opening NAV is what? Number of units is what? Original amount of investment should be how much? What are the following statement about expense ratio? Array, this looks, is the percentage of income that was spent to run a mutual fund? No, it is not income, no. Expense ratio is, it is on total assets under management. Okay, TER or MER. Okay, which is incorrect. So this is definitely incorrect. It includes advisory fees, travel costs, register fees, custodian fees. Yes, it includes all of those. This is correct. It includes brokerage of cost of trading. So this is a very important point. If you go and look at the chapter, they very clearly specify that expense ratio does not include brokerage. Okay, so if they say it includes, then it is wrong. High expense ratio can undermine the performance of a fund. That is true. So answer should be 1 and 3 put together, which is B. But I think in the answers that I think they have incorrectly given it as D, but the correct answer is B. Both 1 and 3 are wrong, because percentage of income that you spend running a mutual fund is not expense ratio. Percentage of total assets under management that you spend, total expenses divided by total assets, that is the expense ratio. Then dash consideration uses downside deviation instead of standard deviation. Now I hope you guys remember there is something called a Sortino ratio, where instead of considering Sharpe ratio, you consider the overall standard deviation. In case of tenor ratio, you consider the beta. In case of, I don't know what is the expense ratio is no longer relevant here, but Sortino ratio is instead of considering all upside deviations, you consider only downside deviations. Okay, so these two, we need not in fact even look at the case. Now come back to the case. They have declared a dividend of 9.99% on the units under dividend reinvestment plan for the year ended March 21. Investors are issued additional units for the dividend at the rate of closing NAV for the year. So there is some NAV and there are some units. Based on the NAV, dividend of 9.98%. Please note, when they say 9.98% of units, what does it mean? Original units into face value. What is the face value, have they said? Yeah, assume face value of 10 into 10 into 9.98%. So let's say you have 10 units. 10 into 10 rupees face value is 100. 100 into 9.98% is 9.98. That 9.98 is your dividend, which is reinvested at the closing NAV rate. The closing NAV was 24.95. So which is what I was saying. An investor Mr. X, who is having 20,800 units at the year end, has made investment in units before the declaration of dividend at the rate of opening NAV plus an entry load of 0.04. The NAV is appreciated by 25% during the year. Assume face value 10 based on case and answer the following questions. No need to work anything. First see the question, then work. Opening NAV. What is opening NAV? NAV is appreciated by 25%. What is closing NAV? 24.95. Opening is X plus X or X into 1.25 is equal to 24.95. So you just need to divide 24.95 divided by 1.25. 19.96. 19.96 is the answer. Then the number of units purchased. Whom are they referring to? They are referring to Mr. X. So Mr. X has closing 2,800 at the year end. Now is this before dividend, after year end? They very specifically mentioned at the year end and made an investment in mutual fund before declaration of dividend. He is invested before. So this is definitely after. So how much did he invest? He invested X. Okay, and at opening NAV, and he invested at opening NAV, X units at Y NAV, okay. And what is the NAV? Opening NAV we got 19.96, okay. So I need not call it Y NAV, it is 19.96 plus entry load of 0.04, so plus 0.04. So he purchased X units at 20 rupees, okay. On this he got a dividend. How much is the dividend? Into 9.98%. This dividend, he was allotted units at closing NAV. What is closing NAV? 24.95. So 24.95. And his closing units is what? So this gives you what? This gives you number of units that are allotted. Okay. What is original units? X. Original units is X. On X, he got, he made an investment of X into 20 as opening NAV. Now, this should not be 20, it should be 10. Okay. Opening investment is how much is what? Different thing. NAV they clearly said 10, no? So X into 10 is his original face value of his original investment. Of that, 9.98% is the dividend he gets. That he reinvested at 24.95. So he got revised number of units. So this X original units plus this dividend units is equal to 2800. And you have to solve for this X. So what is this? 10X into 9.98%. 0.0998 into 10 divided by 24.95 is equal to 0.04. X plus 0.04 X is equal to 2800. So 2800 divided by 1.04. So X is equal to 20,000. So he originally had 20,000 units. This is the answer. You have to make an equation here, or you have to, basically what did I do? Originally he invested X units. So his current original invest units discount is X. How much is the dividend units? He got X units what he had into 10 rupees is the face value, because dividend is declared as a percentage of face value. And what is the dividend percentage? 9.98. This, the numerator gives you the total dividend amount, which was reinvested in the fund at 24.95, which is the closing NAV. So he got this number of units. This units plus original units is equal to 2800. Solve for X, you get answer as 20,000. Okay. Then original amount of investment, very simple. He invested at what? We already decided here, 20. And he invested how many? 20,000. So 20,000 into 20, 40,000 over. Okay. Then case scenario 3. This is illustration 4. Which chapter? Derivatives chapter. Ditto question actually. Okay. Again, I'll solve this just so that you know. Let us look at the questions first, then this thing. Expected share price at the end of 4 months. If call up exercise price prevails, what will happen? In case the option is held to maturity, what will happen? In given scenario, different scenarios of expected price of shares at the time of maturity, options will be in the money in how many scenarios? Should be out of the money, at the money at how many scenarios? So we have to go through the case. Okay. The investor purchased 4-month European call on equity shares of X for 10, on which current market price is 132 per share and exercise price is 150. So spot is 132, K is 150. You expect the price to be between 120 and 190. The expected share price and related probability, 120, 140, 160, 180, 190 different probabilities. If you multiply these two and get a value, what is that? That is the expected share price. Can you subtract strike price 150 and from the expected share price and arrive at an expected value of option? No, that is what you should not do. For option at each level, you should find out the payoff and that you multiply with the probability. Okay, what is the first question? Expected price of the share. What is expected price? I just simply said multiply this. 120, 5% is 6 rupees. 140, 20% is 28. So 28 plus 6 is 34. Then 160, 50% is 80. So 34 plus 80 is equal to 114. Then 180, 10% is 18. So 114 plus 18 is equal to 132. Plus 190, 15%. 190, 10% is 19 plus 9.5. So you got 132. 132 plus 19 plus 9.5. Okay, that makes it 160.5. Yes, it is there. Answer is 160.5. Very simple. Suppose the exercise prevails and the price prevails at the end of 4 months. Option value should be, what is the exercise price? On due date, exercise price is 150. You purchased, your option is also for 150. If exercise price prevails, that is on the due date, if option market price is exercise price, what gain have you made? Zero gain. Okay, this is a twisted question. I mean, a lot of people get confused with this question. The value of the option is 0. In case option is held to maturity, expected value of the call option. Please do not do using this 160.5. A lot of people will go and mark this as the answer. This is wrong. That is not the answer. We will find out. Why did I say that as the answer? They will say 160.5 minus 150, so it is 10.5, near about it is 10, so let me give us 10. No, it is not. At each level, you have to see whether option is exercised. At 120, is it exercised? No. 140, no. 160, yes, because you have a right to buy at 150 when market is at 160. You'll make a gain of how much? 10 rupees. What is the probability? 50%. Then at 180, what is the gain? 180 minus 150, which is 10%. 190, 40 into 15%. So this is 5, this is 3, this is total 14. Answer should be 14, yes. Okay, at each level you check whether the option is exercised. In the given scenario, in the given different scenarios of expected prices, at the time of maturity, option shall be in the money. In the money means what? You are making money. How many times you are making money? In all these 3 scenarios. So answer is 3 for that. In the given scenario, the time of maturity, the option shall be at the money. At the money means exactly at 150. Do we have a probability for 150? No, we don't have. So answer is 0 in none of the scenarios. Okay, this is the answer. So see, it's a fairly simple thing. It is not complex, right? And again, as I said, it is directly from P600 plus the questions. Okay, now let us come to descriptive questions. Now this first descriptive question is a risk management chapter. Ditto. In fact, there is no change. Illustration number 4. Risk management chapter, illustration number 4 on VAR. Absolutely ditto. There is no difference. Then this MNP has declared and paid annual dividend of 4, it is expected to grow at 20%. Then this is security valuation chapter. Security valuation equities, the illustration is number 3. Security valuation equities. Then what is concept of unicorn? Unicorn, you know what is a unicorn? Something which has a value of over 1 billion. It can, you cannot write one line. In fact, you should say what are unicorns. India has more than 100 unicorns. Unicorns have, are valued greatly by investors. They are called as unicorn because they are very rare. And if, there is something called as decacorn when the value is more than 10. Then you also have revenue unicorn where revenue touches $1 billion. And if a unicorn, if its valuation falls below 1 billion, it is no longer called as unicorn. So you have to write all these points. Then, Mr. H as a treasurer for your bank. No, as a treasurer. As a treasurer for your bank, working under you, sold a 10 million HKD for your customer at 10.53 and covered yourself in London market on the same day. US dollar is so and so, interbank rates are so and so, required to calculate cover rate, profit and loss. Do you agree with the views of the internal auditor? There is an internal auditor that H is speculative nature. I don't know why is this speculative. I saw the answer, they said that it is speculative, but it is not speculative. You covered it yourself. Okay, you already, I don't know how quickly they covered it. If they covered it immediately, then transaction is not speculative. If you waited for the end of the day, covered it during the day, sometime whenever it is beneficial, then it is speculative. Okay, this question, this is Forex chapter, illustration number 4. Straight away from P600. Please note P600 plus. This is the document. What is P600 plus? Please check the description below. It is available. Then PFL is engaged in production of fertilizer and considering a proposal value of new plant to produce pesticides. NPV is 200 without abandonment option. What is this? Real options. And what is this? This is question illustration 25 from derivatives options part. NP will increase by 30%. If not interested in continuous product, can be disposed of for 160. Interest risk-free rate is 8%. Find the value of the option. This is straight from the P600. There's nothing that needs to do. Explain various quantitative, qualitative factors to be taken into account in addition to explain various qualitative in addition to quantitative factors to evaluate performance of a mutual fund. So, what are qualitative factors? The kind of portfolio, what is the churn, then what is the kind of companies that you have made investment, what is the background of the AMC, what is the fund manager experience, what is the history of the fund. So you have both quantitative and qualitative factors. There is a good enough explanation that is given in the material, and it is also given in as far as the this MTP solutions are also concerned. Okay, so you can go through that. Then illustration 3A. A owns a portfolio with following characteristics. This is a portfolio management illustration 51. Okay, it's a two-factor model, and in this model, there is an incorrect this thing. So I will not explain the full question. The question is basically you have 2 factors and sensitivities. You are requested to compute the sensitivity of portfolio if Mr. A has 3 lakhs in one. If he has 3 lakhs to invest and sells short on 150 on security Y and purchases 450 of security A. Suppose Mr. D, one of the friend of A, says expected return premium factor 2 is 0. Do you agree with this statement? Substantiate answer. Actually, they should have said factor 1. This is a mistake that they made, because when you go and solve the question, you will see that answer is factor 1. I'll show it to you. Okay, so if you look at this, what are the equation? 5 is equal to 0.8 lambda 1 plus 0.6 lambda 2. Then 10 is equal to 1.5 lambda 1 plus 1.2 lambda 2. So if you subtract one from the other, 5 is equal to, not 1, you double it and subtract. So this into 2. So you subtract this, this is 0. So minus 0.1 lambda 1 plus 0. So lambda 1 is equal to 0. Now what did they say here? They said premium of factor 2 is 0. Okay, so they gave right answer there, wrote wrong answer here. Okay, so don't worry about it. Then there is a privately held company that is operating in retail space, scouting for angel investors. This is business valuation, illustration 1, I think. I'm not wrong, illustration 1, yeah, business valuation chapter. Okay, there's nothing in this. I'm not going to solve it. You please go and have a look. Business valuation, illustration 1 from P600 plus. Then explain various types of swap. What are the various types of swaps that you have? Basis rate swap, asset swap, then you have plain vanilla swap, so on and so forth. Principles of active portfolio strategy. Again, please go through the material or go through the MTP, you'll understand it. Then BDR is an Indian export house. Company prepares invoice in currency. Data's amount is so and so. Currency futures. This is on currency futures. This is Forex, illustration 56. Okay, so there is nothing new in this. Then there is a convertible bond with a face value of 5,000 issued at 650 per coupon rate. The conversion rate is 14 shares per bond. Current market price is 7.5 and respectively. What is the stock value? Stock value is just price of the number of shares per bond. 14 into price per share. 400, that is 5,600. Okay, this is illustration 23, very similar to illustration 23 of security valuation bonds, but I'm anyway solving it. And premium over conversion value, the market price is how much? 7375. So 7375 minus 5,600 divided by 5,600. Okay, that is the thing. Then although rating agency secondary to the process of execution plays a vital role. Yes, it plays a vital role because they go through all the historical payment patterns. They look at the financial strength. They check whether all the SPV is structured properly. So they are a very, very important secondary aspect as far as securitization is concerned. Then 5A, during the audit of weak bank, our bank suggested that it should merge with another bank or close down. Strong bank has submitted a proposal for merger. So this also is question number 32 from M&A chapter. Okay, this is slightly lengthy, but it's the same question. Then Swift plays an important role. I explained to you, I told you also Swift is a very, very important thing. It is worldwide messaging system. It is not money transferring system, it's a messaging system. Okay, and on that I've explained the 3 INR currencies. Each currency has a code. This makes it operationally easy, moves money it moves messages very, very fast and all that. Then 6A. There are 2 projects, X and Y, both have same life, require equal investment, both are estimated to have almost same yield. The results of cash flows are as follows. Which of the 2 projects has more risk for every person? This is coefficient of variation. This is advanced capital budgeting decisions, illustration 10. Okay, then following data percentage, HPS engaged in software consultancy business. They're asking find out EVA and MVA. This is business valuation, illustration 35. So you tell me what has not come from P600 plus? Every single thing has come from P600 plus. If it has not come, it has been very simple. Theory, of course, has come from P380 plus. I've given you important theory questions also. I've given you entire theory compiler as well. Okay, so you see, this is a very, very easy thing. Even though it is not required, I went ahead and solved all the MCQs for you. Even though the MCQs are already, they're not very complicated MCQs, very, very simple stuff, right? So this is how it is. We have finished the first mock test paper, series 1, September. Now, let us go and look at second mock test paper, series 2, which is in October. Okay. So friends, now let us look at series 2, that is October 24 MTP for CA Final AFM. Now, what is this? Case and questions. First questions. Primary purpose of CDS. This is a question on CDS. Wonderful. I have been telling everybody there will be a question on credit derivatives either in November 24 or May 25. Wait and watch. Primary purpose of CDS is what? Do we need to go through the case? No. Increased value of bonds, no. Protect against default risk of a debt obligation to provide guaranteed profit to buyer to new form of loan. It is B, to protect against default risk of a debt obligation. Very simple, you need not. Credit default swap. Which of the following statements is true about CDS? They cannot be used for speculation? No, they can be used. What is there? They are governed by government regulations? No. They are private agreements between two parties? Yes. CDS contracts eliminate all risks? No, they don't eliminate all risks. They eliminate the risk of bankruptcy. What about the risk of change in interest rates and all of the other risks? All those are not eliminated. Which organization publishes guidelines and rules for conducting credit default swap transaction? ISDA. Yes. Then assuming no default, premium will how much? If suppose lender defaults, market value of the difference falls to 75. Okay, these two we have to go through the case. Suppose you are a risk manager at a financial institution. Your company has loaned a significant amount of 500 crores to another company. Okay, you have loaned to X for a period of 3 years at 6-month MCLR plus 200 bips. You are concerned about X ability to repay due to recent volatility. To protect the institution from potential default, you decide to purchase CDS from ABC for the same notional amount, premium quoted 1% per year through cash settlement. 1% per year of what? Of 500 crores. So how much is it per year? For per year 5 crores. So for 3 years 15 crores. Okay. And MCLR as follow. Okay. Now let us see what is the question. Assuming no default occurs, the total premium company will pay during the designated loan period shall be 15 crores. Simple. We just computed it here, 15 crores. Suppose if the lender defaults somewhere in the beginning of the third year, so for 2 years you have paid, after payment of interest, so 2 years interest also paid, and the market value of reference rolls falls to 75%. So 500 falls to 75%. So it falls to 75 into 5 is what? 35, 375. So it falls to 75. Then ABC will pay your company how much in cash settlement? Will they pay you 500 or will they pay you 125? That is the question. Okay. It depends on the kind of contract, but if it is a full exchange, it is full swap, then it is 500, otherwise it is 125. So in this case it is 125 because, have they used that word anywhere? Through cash settlement. They said cash settlement here, probably so, but typically you give off the bonds and get your entire money. That is one way in CDS works, and other ways you get whatever is the default value you get. Okay, both the cases are there. It's not a right question to ask by ICAI because they have said it as 125, because there are cases, there are CDS which are structured, material only says, where the entire 500 is exchanged. And then case 2. Okay. Case 2, initial cost, sales price, what is this? Based on the above, identify the following question, sensitivity. This is advanced capital budgeting. This is question number 22, illustration 22 of P600 plus, straight illustration. Okay, same to same. Sensitivity analysis helps to identify what? Exact profitability? No. Break-even point? No. Degree to which each variable affects NPV? This is correct. Okay, I have not even gone to the question. The sale price so that project would break even? I don't know. Cost price so that project would break even? Don't know. We'll have to find out. This we'll have to find out. This we'll have to find out. You can please go through illustration 22. I have given in great detail how this question is to be solved. You have to solve it. Okay. I don't want to get into this. See, the CDS is a something which most of you don't know, but this advanced capital budgeting is something very simple. So I don't want to spend time on this. An investment analyst working for financial advisory. Wait 1 minute. Come to the questions. The main characteristics of a normal yield curve. What is a normal yield curve? Normal yield curve is like this. Okay. Short-term yields are higher than long-term yields? No. Short-term yields are lower than long-term yields? Yes. The yields remain same? No. Yields fluctuate randomly? No. Answer is B. Based on revised data, yield spread, we don't know. Inverted yield curve typically means what? Inverted yield curve means it is like this. Short-term rates are high, long-term rates are low. What does this refer to? This refers to upcoming recession. It is upcoming recession. It can also mean inflationary pressure because when short-term inflation is very, very high, the RBI raises the interest rate. So interest rates go up substantially. Okay, it can also mean inflationary pressure, but it is a more that indicative. That is, it can mean that currently there is a inflation, but it is a lead indicator of what? So when there is inflation, when you raise the rates, what typically happens? The economy slows down. So there is a recession that is coming. So answer is C. Then investors looking to invest, I don't know, we'll have to check. Investors looking to invest 2 years, I don't know, we'll have to check. We'll go and check. You're an investment analyst working for a financial advisory firm. You have been asked to analyze the bond market yield curve to assist your clients in making investment decisions. The yield curve represents relationship between interest rates and time to maturity for debt securities, usually government bonds. Simplicity, assume the following yield rate of government bonds over various periods. So yield is 3, 4, 5, 6, so on and so forth, up to 7.5. Now it is a normal yield curve like this only. Okay. Based on the revised data, what is the yield spread between 10-year bond and 1-year bond? Simple. What sort of question is this? 10-year and 1-year, 4%. Then an investor is looking to invest for 2 years from 3 years from now, forward rate he should be. 2 years for 3 years from now. So 5 and 6. So what you do is 1.06 into is equal to 2 times, 3 times. Basically you do 1.06 power 3 by 1.0605 power, 2 for power 5. 1.06 power 5 by 1.05 power 3 whole root minus 1, whole power 1 by 2 minus 1, right. So 1.06 into is equal to 1, 2, 3, 4, 5 divided by 1.05 is equal to 1, 2, 3. This you do a square root, minus 1 into 100, you get 7.51%, 7.5178, so 7.52. Then investor is looking to invest for 2 years, starting 5 years from now, forward rate of these two. Okay, I'll put different color. So what you do, 1.064 power 7 divided by 1.06 power 5 under root minus 1. Okay, what is this? This is bootstrapping method. When the rate is 6.04 for 7 years compounding, divided by 1.06 5 years compounding, the rate that you will get is for 2 year period. You do take square root of that and subtract 1. So 1.064 into is equal to 1, 2, 3, 4, 5, 6, 7 divided by 1.06 one time, 2, 3, 4, 5. You get 1.1536, you take square root and subtract 1 into 100, you get 7.406, 7.41. Yeah, 7.41 is the answer. Fairly simple, nothing complex. Then descriptive questions. What are these descriptive questions? ABC startup has following expected profits and different scenarios and respective probabilities. Okay. Revenues, expenses, and 3 cases. Probabilities 30%, 60%, 10%. You are required to suggest the value of ABC using first Chicago method. What is first Chicago method? Simply the weighted average of all 3 valuations. There is nothing else. I know this appears as if it is a complex thing. It is actually not a complex thing. Okay, we will see this, but because this kind of a question has not been, we don't have it in the material, but it is a very, very simple problem. We will solve this. Discount rate is 20%. Startup is located in tax-free zone. Terminal multiple for terminal value is 10. No depreciable asset held by APC startup. Present value factors are going so and so. Round of calculations to whole numbers. Okay. So let us look at the solution. What are the things they are saying? This is how many zeros? 1 lakh, 100 lakh. So this is 1 crore. Okay. So you have 1 crore. Discounting rate is 20%. So let us look at the solution. First, best case scenario. 1, 2, and 3. 3 years. Revenue, cost, CFAT. There is nothing else. Applicable discounting rate, tax free. So whatever is cash flow before tax is after tax. Okay. No depreciation, no issue. So directly the difference between those two. 1 crore. Then 80 lakhs is 20 lakhs. 1.2, 92.4 lakhs. 1 crore 20 lakhs. 92 lakh 40,000. So you get 20 plus 7.6, 27 lakh 60,000. Then 144, 108. 1 crore 44 lakhs. 108 lakhs. Which gives you 36 lakhs. How? What is the thing? 0.833, 0.694. So 20 lakhs into 0.833. How many? 0.8333. So 833. 0.6944. 27.6 lakhs. 0.5787. 36 lakhs. This comes to what? .6944 into 27 lakhs 60,000 is equal to M plus 0.5787 into 36 lakhs is equal to M plus. You do memory recall, you get 56 lakhs 66,464. Okay, plus multiple for the terminal value is 10. So what is the terminal year value? Terminal you got 36 lakhs. So plus 36 lakhs into 10. This is how much? 56 lakhs 66,464 plus this is present value of cash flow explicit period plus 36 into 10, right? That is 3.6 crores. But this 3.6 crores is at the end of year 3. So terminal value, present value of TV is equal to 3.6 into 0.5787. 3 crores 60 lakhs into 0.5787 is equal to, so M plus memory recall, you get value 2 crores 64 lakh 99,664. Okay, this is the best case. Then base case, what is the base case? 190. So these are all painful questions. There's no major value add. You have to keep on doing computation. Revenue, cost, 90 lakhs. CFAT is 10 lakhs. Then 110, 95.7. So 110, 95.7 gives you 14 lakh 30,000. Then 121, 102.85. So this gives you 19 minus 85, which is 18 lakhs 15,000. Again same story, which is what? These three ratios. 0.8333 into 10 lakhs is equal to M plus 14 lakh 30,000 into 0.6944 is equal to M plus 0.5787 into 18 lakh 15,000 is equal to M plus memory recall. You get pre-V explicit is equal to 28 lakh 76,633 plus 0.5787 into 10 into 18 lakh 15,000. 10503405 plus 28 lakh 71,633 is 133,80038. 1 crore 33 lakhs 80,038. Okay, 1 crore and 95 lakhs 102 98.94. 1, 2, 3. This is year, revenue, cost, CFAT, 1 crore, 95 lakhs, 5 lakhs, 102 lakhs, 98.94. So 102 minus 98.94. This gives you 2 lakhs here, 1 lakh here, so 306,000. And this is 104,04,000 minus 101,95,920 is 208080. So 208080 into 0.5787 is equal to M plus 208080 into 10 into 0.5787 is equal to M plus 306,000 into 0.6944 is equal to M plus 5 lakh into 0.8333 is equal to M plus. So you get PV of explicit plus PV of TV is equal to 1953,711. 1953,711, 19,53,711. Okay, so what are the best, base, worst? What are the probabilities? 30, 60, 10. Value. One three three 80038. Then 26499,664. Okay, so 0.3 into 26499,664 is equal to m plus 0.6 into 133,838 is equal to m plus 0.1 into 19,53,711 is equal to m plus. Memory recall 1,61,73,293. So this is the value. What is for Chicago? Nothing but simple expected value, that is basically probabilities multiplied by the valuation. That's all. There's nothing else in First Chicago. Okay, please go back to the chapter, business valuation chapter, if you have any doubts with respect to which are the various types of valuation. Okay, now let us look at the next question. Second question from MTP October 24. Calculate the value of one equity share from the following information. Profit of the company before tax is 8,000 crores, equity share capital 19,000, number of shares is 380 crores, long-term growth rate is 7%, risk-free rate is 9.5, beta is 0.1, market risk premium 3.1, total capex 20,000 crores, chargeable depreciation 17,000 crores, increase in working capital is 1,700 crores, new debt issue is 2,000 crores, tax rate is 30%. All calculation to be rounded off to 4 decimal and final value of equity should be rounded off to 2 decimals. Now, this is very similar to illustration 35 in business valuation chapter, but we will solve this separately, okay, because it is not same to same ditto, okay, very similar, that's all I said, okay. Okay, let us go and look at the solution. PBAT or PBT, I'm sorry, PBT 8,000 CR. They've given any tax rate? Tax rate is 30%. So PAT, this is FCFE method, okay, FCFE, free cash flow to equity. What is PAT? 8,000 crores minus 30%, that is 8,000 CR into 1 minus 30%, 5,600 CR. Okay, then we'll write the formula for PAT, subsequent formula for FCFE subsequently. Let us first get the data out. Then share capital is equal to 19,000 CR. Equity shares is equal to 380 CR. Implies face value per share is equal to 19,000 divided by 380. Rupees 50 per share. Then growth rate is there, risk-free rate is there, beta is given, market risk premium. What is the, so first FCFE. What is FCFE? What is the cash flow that is attributable only to equity shareholders, which is, you can do it from FCFF also. First we'll go the FCFF route. First FCFF. What is FCFF? FCFF is, you can come back from PAT or you can do it from EBIT. Do we have EBIT? Would it to be issued? Nothing. Tax rate, have they given the interest, capital, new debt to be issued? This is to be issued. FCFF from PAT. PAT plus, are we given any debt details? No. So first let's add back depreciation, because we have taken the effect of depreciation, tax benefit has been taken, minus increase in working capital, minus capex, Then new debt issued for funding. Okay, so that is not part of FCFF, that is FCFE. Okay, so this is what it is. And what is FCFE? FCFE is equal to FCFF plus new debt issued. Okay, any other data points? No. Okay, in this context, okay, you also have other changes that may be required, plus interest and all those changes should be there, but in this particular question, this is what it is. So FCFF is equal to PAT. What is PAT? 5,600 plus depreciation how much? 17,100 minus increase in working capital 1755.6 minus capex 20140. So as far as the company is concerned, 5,600 plus 17,100 minus 1755.6 minus 20140. This is 804.4 FCFF. FCFE is equal to 804.4 plus new debt issued. What is the new debt? 2062.108. It's equal to 2866.508. Okay, so when you look at normal FCFF, right, you also will, normal FCFF or FCFE will also have plus new debt issued minus debt repaid minus preference dividends plus pref issued minus pref repaid, all this. Okay, but in our case all those are not there. FCFE we directly got this value. Now from this FCFE value, what are we supposed to arrive? Value per share. So this is FCFE. What is cost of equity? We have to arrive first of all at FCFE. If it is FCFE, cost of equity, not WACC. So KE is equal to RF plus beta into MRP. Here it is, risk-free rate is what? 9.5% plus 0.1 into market risk premium is 3.1. 3.1 into 0.1 is equal to plus 9.5 is equal to 9.81. Okay, so value of company, company's equity is equal to 2866.508 divided by KE minus G. What is KE? 9.81 minus 7%, right? Minus 7 is equal to 2.81. So 2, and this also, this into 1.07 by 2.81, I made a mistake. Equity is equal to D1 by KE minus G. Okay, next year's cash flows. So 2866.508 into 1.07, that is 3067.16356. They said something round off to 4 decimal points. So 6 divided by 2.81% by 0.0281. That is equal to 109151.7281. Equity share is equal to 109151.7281 divided by how much? 380 crores. All this is in crores. Okay, that's equal to rupees 287.24. 287.24. Answer is 287.24. Okay, now we finished question 2. Let us move to the next one. Multinational companies planning to set up the subsidiary. This is international financial management. This is question number, illustration number 9, straight from P600 plus. I'm not going to read it. Variable cost, everything is same. There is no, numbers are also not changed. Then following are details of portfolio consisting of 3 shares. You are given market portfolio returns. You are given additional data covariance. Calculate the portfolio beta, residual variance, Sharpe index, portfolio variance on basis of modern portfolio theory also. This is portfolio management question number 59. Straight. Need not do any work. Everything is there in P600 plus. Then Explain types of interest rate risk faced by the company. Okay, you can go through the material. I've given this areas where blockchain can be applied. I told you this is also a very, very important question. Where all can it be applied? It can be applied in blockchain technology, can be applied not only for currencies but also in e-governance, tokenization, real estate, then smart contracts, a variety of those, right? Then on an open-ended scheme of mutual fund at 300 lakh units. Now this is also mutual fund chapter, straight away question number 26. There's no change in data points, everything is same. Then following are spot exchange at different forex markets, arbitrage is so and so, is arbitrage gain possible? This is forex chapter, question number 10 from our material as P600 plus. ICL is proposing to take over SVL with an objective to diversify. Okay, this is M&A chapter, question number 39. Nothing needs to be done. Then 39, I need not solve it. It is already available in the P600 plus material. Go and have a look at it. Characteristics of GDR. GDRs are very simple. Okay, they're listed in Luxembourg. There is depository who will issue shares here, who will take the shares here and issue GDRs there. It can be used for fundraise and all of that. Then Sensex switches are traded multiple of 50, so and so during February. You're required to determine daily balance in margin account and payment on account of margin. This also very, very clear. We have done this particular question. This is question number 14 in derivative chapter. Okay. Technical analysis, several supporters as well as critics. So what is technical analysis? Where does it work? It works in inefficient markets. It does not work in weak or even semi-strong markets. Okay. Then there are various kinds of technical analysis. It is just, you're doing a lot of data mining. Whether there is any outcome or not, nobody knows. Okay, and then there is no science to it. This is not logical. It is more on behavior related aspects, right? So these are the aspects. If we want, we can actually see the answers also. So crowd psychology, shift in demand instantaneous can help in detecting the shift. Fundamental information about companies observed and simulated. Hence price will, so these are positive things. Hence price will reflect, tends to move in the same direction. Detractors, they are not able to offer convincing explanation. Empirical evidence casts of random walk process casts a shadow. By time of uptrend, downtrend may have signated by technical analysis, it may have already taken place. Must be self-defeating. If more and more people employ it, you cannot get it. So this is also a fairly simple one. And this one, as I told you, is already available in our P600 plus. Anything else? GDRs, I told you what are all GDRs. Then this is done. This we have discussed. This we have discussed. This we have discussed. I think only theory were the ones where blockchain, financial services, healthcare, government, travel, economic forecast. Okay, so I told about registration, vehicle registration management, e-voting, real estate, right, money transactions, so a bunch of these stuff. What are the various risks? Gap exposure, basis risk, embedded option, this is interest rate risk, yield curve risks and reinvestment risk. I explained this in the last day revision for interest rate risk management chapter also. That particular PDF is also there available, right? Anything, I think we have done everything. What are the points to be kept in mind while preparing a pitch presentation? Introduction, team, problem, solution, marketing, competition, milestone, business model, what in financial projections, you have to give about all these aspects. Okay, so I don't want to get into too much details because all of this has already been covered. Okay, you guys can go through P600 plus and T380 plus and you can find all answers. I've given you very clearly where each question has been picked up from. Okay, so this is a overall review of MTPs that have been released for November 24, both the September series as well as the October series. Please study well, don't unnecessarily get tensed. If you have put in the effort, you already know a lot of stuff. Don't unnecessarily get tensed and don't compare papers with others, compare your answers with others and all that. Even though we will release solutions immediately after the exam concludes, my suggestion, stay away from social media or anything and concentrate on exams. Okay, chalo, all the very best.